I want to welcome all of you to the Going International, the Opportunities and Challenges webcast. My name is Jeff Ersprung. I'm a Senior Vice President at William Gallagher Associates, and I'll be moderating today's webcast, and we'll be hearing from several experts in the field of corporate global expansion. During the webcast, you have the opportunity to submit questions. If you look on the right-hand side of your screen, you'll see the GoToWebinar panel. You can submit your questions through that application, and we'll address as many of those questions at the end of the webcast as our 1-hour time frame allows. Also, after the webcast, we'll be posting a PDF and an audio file of the presentation to our website, and we'll send you a password via email for access to the presentation. When expanding globally, there are many important corporate considerations, including compliance requirements, tax implications, salary levels, benefit package design, and risk exposures. Our webcast today is designed to provide information on these areas to firms who are either considering global expansion, have already begun their expansion efforts, or those with mature global operations with a sense that those operations could be more efficient. Let me introduce our 3 webcast participants and at the same time introduce you to William Gallagher Associates and to Nair Company. First, from William Gallagher Associates, we have Christine Gomes. Christine is an Assistant Vice President with the Employee Benefits Practice at William Gallagher Associates. She has 10 years of experience in the insurance industry and has been with WGA for 7 of those years. Christine holds the Group Benefits Associate designation from the International Foundation of Employee Benefit Plans and is an active member of the Worldwide Broker Network, of which WGA is a founding member. Let me say a couple words about the Worldwide Broker Network. The WBN was established in 1989, and it's the world's largest organization of privately held insurance brokers with 60 brokerage firms in 48 countries. As a result of the work that Christine does within the WBN, she has personal and professional relationships with brokers throughout the world. Next from WGA is Bruce McDougall. Bruce is a Senior Vice President in the Property Casualty Group. He has 25 years experience in the insurance industry and holds the Accredited Advisor in Insurance designation. Bruce works extensively with many of his clients on developing risk management strategies for their international operations. Here on the bottom of the slide, you'll see some of the areas where Christine and Bruce can assist you with both international employee benefit plans and risk management services. Finally, our feature panelist this afternoon is Dr. Shan Nair. Shan founded Nair Company in 1994 and now leads the strategic operations and global group expansion for the company. He's considered an expert in international expansion, and he practices what he preaches. He's lived in 13 countries worldwide. Dr. Nair is an Oxford University PhD nuclear physicist and has received recognition for his success in business, including the 2008 Outstanding 50 Asian Americans in Business Award. His firm, Nair Company, has offices in the U.S., the United Kingdom, India, China, Japan, and Singapore. Nair Company has more than 400 employees worldwide and works with more than 700 foreign operations in 43 countries. Again, welcome to all of you listening, and now I'll turn the webcast over to Dr. Nair. Shan?
Ladies and gentlemen, good morning, good afternoon, or good evening, depending on the time zone you're in. It's a pleasure to be here. In this presentation, I'm going to focus on 2 quite different but related scenarios. The first relates to a company that is about to enter a new country for the first time. It might be on its first venture abroad, or it might be already abroad but entering a new country for the first time. The second relates to a company with small headcount, multi-country operations that is facing a variety of headaches. The next slide shows some of the issues that arise for the first type of scenario where you are starting up in a foreign country for the first time. The questions that arise in chronological order are listed in the slide. First of all, you need to know before you even start the hiring process what the going rates of remuneration are for the type of people that you're planning to hire. Once you've done that and you found the person, you need to establish what is the employing entity going to be in that country. In other words, you need to establish your tax structure. Once you've done that, you need to ensure that you send out employment documentation that is compliant with the laws of that country. So now at this stage, you've got the employee on board. You now have to support him or her. So you have the issue as to who will run your payroll for your small headcount operation and how are you going to keep the accounts. If the entity that you've set up is a branch or a subsidiary, you will have to worry about transfer pricing issues because they're soon going to become relevant within about 3 months of your operation. You also need to know all your compliance deadlines so that you need to be aware of what you have to do by when. If you're giving your employee stock options, or in the event that you're a public company, you have ESPP operating for your international employees, you need to be able to figure out how to handle these issues when you're running the payroll in these countries. And then last but not least, there are special issues that could crop up from time to time that you need to be sensitized about in order to ensure that you deal with them well in advance and not fall into a hole. So I'm going to cover these very quickly, and hopefully we'll have lots of questions and answers afterwards. Essentially, moving on to the second scenario, which is the company with small headcount multi-country operations. My first problem is how do I save my VP of HR from the 80-20 syndrome, 80% of the VP's time spent on 20% of my foreign employees. Essentially, that is an issue that I need to deal with. I'm now in multiple countries, so how do I ensure that I'm in all my entities are in good standing? How do I manage my payroll and my multi-country day-to-day accounting? And in particular, in the latter case, how do I ensure that all of my multi-country accounting is done consistently? And last but very much not least, where do I go for my HR, indirect tax, and stock option consultancy when I'm multi-country? So we're going to consider all of these in turn, mixing and mashing them, and in the end, we will wrap up with a summary. So the next slide covers the issue of being an informed employer when you're making your first hire. Most published salary survey data are not very useful for venture-backed technology companies because they are dominated by the statistics of the multinationals. And essentially, the type of employee who is going to join a venture-backed startup is a different type of person to one who would work usually for a large multinational. So typically with a multinational, there is no opportunity for making a large gain when your company IPOs because the company is already IPO'd. So the focus is very much more on benefits and what's on the table for me now. As an overlay on that, in regions such as Europe in particular, employees are not that hung up on stock options and are more concerned again about what's in it for me now. So you need to be aware essentially of what are the going rates of remuneration paid by companies in your type of space. In other words, venture-backed companies offering stock options with a plan to IPO or to be acquired in a given period of time. What are the going rates of remuneration? What are the fringe benefits for that type of situation? And those data are actually quite different to published salary survey data. They are available, but it takes digging to find them. Allied to that, if you have expat movements, if you're moving expats from either the US to the country in question or from country A to country B, you have issues covering health coverage, travel allowance, and policies, and your company policies associated with that expat movement, quite apart from the normal expat issues of cost of living allowances, tax equalization, and immigration. The next slide.
Shan, let me break in here and ask Christine to join the conversation. Christine, we know that benefit practices vary significantly from country to country, and that there are different government programs in each country, and the culture and tradition of a country can also impact the benefit designs. What are some of the challenges that a multinational employer might face when setting up an international benefit plan design?
Well, first, every employer is faced with the challenge of recruiting and retaining the best employees. We all know that. But this can be particularly challenging when you're trying to fill a highly technical position, because you're trying to recruit people who have very specific skill sets, they're in high demand, and sometimes salary just isn't enough to sway them. So this is where you need to take a good hard look at your benefits package and be sure that the lines of coverage and the coverage levels are not only competitive but appropriate for the countries that you're operating in. Now, of course, it's very easy to say that we want to offer the best package, but in this economy that might not be possible. We're all faced with budget constraints, so managing costs becomes extremely important, and I just want to give a couple of examples of where we can help out with that. So first example, if we're dealing with expats, we can set up a plan that includes medical, dental, life insurance, disability, evacuation coverage, all under one umbrella for one price. And most likely, this is going to be a lot cheaper than setting up individual plans all over the world. Plus, it's going to make administration easier because you're only dealing with one carrier. So when you take this approach, you're essentially killing two birds with one stone. Now, if you do not have expats, but you have employees spread out through the world, then maybe we look at multinational pooling. This is where you combine the claims experience from each country, and if that experience is positive, you, the employer, get a dividend or money back. If it's negative, there are a couple of things that can happen. Either the loss is carried forward, or in certain situations it can be absorbed by the network or absorbed through stop-loss coverage. So there are some opportunities to save money here, and of course there are requirements that you need to meet, but these are a couple of things that we can look at when sitting down and talking about strategy to help you contain costs. Once you've got that framework in place, you then need to pay particular attention to your retirement and health care benefits. In many countries, the government is involved with providing some coverage here. So you need to understand the Social Security system, you need to review the laws, and then decide whether or not supplemental plans are needed. So my recommendation here would be to do some benchmarking so you really get an understanding of the culture. And that really leads to the next point, which is standardizing benefits across numerous cultures without losing sight of cultural differences. I'll admit that this can be tough, but it can be done with proper planning and by working with vendors that specialize in international benefits. As a broker, we can obviously help with that, but again, I want to stress that understanding the culture is the most important piece when developing your international benefit strategy. As an employer, you want to offer something of value, something that provides financial protection to your employees, but you also want to avoid duplicating benefits that the government provides just to make sure that your costs stay under control. So, in my opinion, these are the biggest challenges that multinational employers are facing, and if anyone has any questions, we do have a Q&A session at the end of the presentation. Please feel free to send along those questions. We're more than willing to help you out. And with that, I guess I'll turn it back over to Jeff and Dr. Nair.
Sure. Thanks, Christine. Dr. Nair?
Thank you.
Want to continue?
Yes, let's go to the next slide, which is slide number 9. So at this point now, I'm still in the mode of the company hiring its first employee in a foreign country, in a new foreign country. So now you've found the person, you know what the going rates of pay are, you found the person, now what? You need to establish what your employing entity is going to be. In other words, what your local entity or tax registration is going to be. Generally, in most countries, you have 3 options. The option of a representative office, which is variously known as RO, liaison office, place of business, and the French used to call it bureau de liaison, but it's basically the same thing. It's a device for hiring and getting a payroll registration for a small number of employees, usually not exceeding two or three that are engaged in non-core activities of your business. By non-core activities, I mean activities that are not central to your business, such as sales or engineering. So, for example, if you are trying to establish yourself in a market and you're hiring a person to establish the scale of the market, the scope of the market, the kind of customizations of your product or service that the market is going to require, that you then feed back to your head office for their action. And in the process, the person might make one or two sales which are incidental and needed actually to test the product or the service. That type of activity can be accommodated within a rep office so long as the person's job title, job description, and remuneration package are consistent with allowable activities of a rep office. So often companies go in low cost into a country by setting up a rep office, but by failing to coordinate the HR documentation piece with the tax piece, they can end up in a situation where they're deemed not to have a rep office, but to have a branch, which is a taxable entity. So the main advantage of the rep office is that it does not have to pay corporate taxes in most countries, and it does not essentially have any filings required other than payroll filings and, where relevant, stock option filings. Having said that, there are exceptions. A rep office in Spain, for example, can be taxable as well as non-taxable, and the same in China. But generally across most countries, the comment that the rep office is not an entity that pays corporate tax is true. The second level of representation you can have in terms of the detail of the infrastructure is a branch. A branch is similar to the rep office in that it's a device for obtaining a local registration of a foreign company. But the difference is that the foreign company can now carry out any type of activity in the country, including non-core activity, including core activities. The branch is a taxable entity, so it has to file accounts and corporate tax returns, the requirements of which vary generally from country to country, but it does basically have to do that. And usually the corporate taxes are assessed on a branch on a cost-plus basis. The big risk of a branch is that because it's not a self-contained entity, all of the regulatory and employment risks look straight through it to the company of which it is a branch. The company of which it is a branch can also, depending on the country, if it operates there for a length of time, end up acquiring a taxable presence in the country or run some risk of doing so. Therefore, we rarely recommend a U.S. company just going and establishing a branch. We would usually put something in between. It could be a U.S. international holdco shell company where a branch can be set up in the particular country, or it could be a local subsidiary where you have employees, a significant number in another country that establishes a branch. But you would normally have the branch of some other entity that isn't very profitable, so that your permanent establishment stroke local taxation exposure is minimized. You need to be very careful in particular if you're setting up branches in India and in Canada, because the tax authorities there are very focused on permanent establishment risks and have a tendency to attack branches and try and sting the company of which the local entity is a branch for taxes arising from its activities in India or Canada. Having said that, there are one or two countries where you effectively cannot have a branch. A good example is Brazil, where you need presidential permission, believe it or not, to set up a branch. And so I don't have a single client that ever wanted to set up a branch in Brazil. The last option and the most substantial option you've got is obviously to set up a subsidiary company. That's pretty straightforward, but you need to be aware that closing down a subsidiary is expensive. So you need to be really sure that you have a market in this country and that you have the intention of a long-term presence. Equally, if you're sure of that, then it could have the opposite beneficial effect for you in that employees or potential employees would tend to take into account the fact that you have a subsidiary as prima facie evidence that you have a commitment to operate in that country and their jobs are therefore safer than if they worked for a rep office or a branch. Customers can also, depending on the country, take that view. So, for example, in an extreme case is Japan, where many salespeople will tell you that in order to sell credibly in Japan, you have to have a subsidiary. You have to set up at least a KK, and the salesperson has to have a business card showing he's employed by KK to be able to credibly sell. Equally, in countries like UK, France, and UK and Germany and Netherlands, less so maybe in France, it's not necessary. You could sell by operating through a branch. So those are the pros and the cons. The next slide basically looks at some of the taxation aspects and setup aspects of a foreign subsidiary. When setting up that subsidiary, it's important that you establish where you're going to book your sales. Many companies have usable net operating losses, NOLs. If there haven't been any significant changes to their capital structures in the U.S., the NOLs may be fully utilizable, in which case they would want to book their foreign sales here in the U.S. The foreign subsidiary would therefore be a sales lead generation organization or a R&D organization which would be remunerated on a cost-plus basis. In other words, the parent covers its costs and gives it a small uplift to guarantee it a profit. You need to look at what type of services you're offering on the ground. If you're selling product, but you're also providing maintenance and training on the ground at customer premises for which you want to bill the customer, there could be indirect tax implications which will impact on where you book these revenues, because if you have indirect taxes applying on a particular type of service, then you can only invoice for those services out of a VAT or GST or registered entity, which then affects where you can book your revenues. So essentially there are a number of issues of that type which ultimately feed back to your contract of sale and may well force you to modify your contract of sale to some extent. The time to set up a foreign subsidiary is also very variable. It can be literally 2 days in the UK and Hong Kong and Singapore, very fast. And at the other extreme, setting up a subsidiary in Russia can take about 3.5 months. Setting up a wholly owned subsidiary in China can take about 2 to 2.5 months. In most of Europe, it takes about 6 to 8 weeks. You also have to decide on the directorship of the subsidiaries. In certain countries like Singapore and Japan, there is a mandatory requirement to have at least one local resident. In other countries like India, there is no mandatory requirement, but it makes life much easier if you do have a local resident director, because the annual general meetings have to be held, in the case of India, on Indian soil. A lot of our clients tend to agree to become directors of local subsidiaries, a lot of our CFOs, CEOs, without actually understanding the personal liabilities that they're taking on, which in certain countries, like in Japan and Australia, can be extremely onerous. And they would be well advised to find out a little bit more of these personal liabilities before they actually sign on. Having said that, one could argue that there's D&O cover that will cover them, and that is certainly true. But again, in certain countries, the level of D&O cover and the choice of carrier are mandated by local regulations. For example, in France, D&O cover has to be obtained from specified carriers, and the premiums relating to the D&O cover for the local officers of a French company absolutely have to be recorded in the books of the French entity. So if the U.S. pays it, it has to be transferred through an intercompany charge to the accounts of the local subsidiary. Also, when setting up subsidiaries, all too often lawyers have a standard set of articles that they just pull out of the cupboard, shake the dust off, and apply. But it's important to do this intelligently. For example, a U.S. company will not want its local subsidiary to have unfettered and uncontrolled rights to borrow money or to sign up to an onerous liability like a property lease. In certain countries, like the UK is a good example, these powers can be restricted while staying within the Companies Act regulations, whereas in other countries like Germany, they cannot. So it's important that the law firm or whoever you use to set up the subsidiary actually does look at these issues before just rolling out their standard set of articles.
Dr. Nair, let me bring Bruce in for a moment to talk a little bit about the need for local placement for traditional property and casualty coverage, and perhaps to elaborate a little more on the director and the officer's liability.
Thanks, Jeff. Hello, everybody. I'd like to start very briefly by putting this in context. And having been doing this for a long time, when I first started, local programs were invariably, for up to even very large companies, done on a what we call non-admitted basis, meaning they were done by policies generally written here in the United States on something we call a different conditions basis. But there has been some significant trends that have changed that, and I'd like to sort of start with those, and then we'll go into a few other steps here. It will ultimately allow my slides to make a little sense. But first, the trends are, pretty simply, I consider them three major trends are taking place that are creating a much tighter controlled and more conservative marketplace in terms of how foreign insurance should be managed. The first one is the financial meltdown. With the meltdown of AIG, now Chartis, and other companies, governments have come under very increased scrutiny and pressure to make sure that the insurance works in every country. The second thing is with various acts of terrorism, financial transactions in general are much more closely monitored, and there are a number of laws on the books in many countries creating greater control over those things. And then, of course, the last one is that many governments have found that the placement of insurance is a source of jobs as well as funds for them, and it's no secret that governments around the world are struggling trying to meet their budgets. The second thing is that once you, and Dr. Nair has mentioned this a little bit, once you have decided on the entity and you actually have a legal entity, in terms of insurance placement, there's some setup time there, and it's very important, in my opinion, to let your broker know exactly what you're trying to accomplish and what the entity will look like as early as possible so that they can have the time to examine any changes that may have taken place in local rules and regulations, because things are changing. In addition to that, to also make sure that they can interface with your existing domestic/master program as effectively as possible. We'll get into a little bit more. And then to the slides specifically, the first one is gives you a flavor of what is going on in various countries for international D&O. The primary issue under directors and officers liability is assuming you have a foreign person who is a director or director equivalency position, such as a managing director or a vice president. Will the country allow for indemnification, number one? Number two, how does your existing D&O policy work? An example would be, interestingly enough, in Germany, there is no insured versus insured exclusion. So when you are placing a policy in Germany, as you can see from our slide in the bottom box, countries where locally limited policies are not required, but you would, in this case, go to your master policy and ask them to add an endorsement specific to Germany that would delete the insured versus insured exclusion for a claim in that country because it is not permitted. If you don't mind, next slide. And then, sort of wrapping this up, this is a little detail on what we general commercial insurance and what countries we are strongly suggesting you get admitted coverage, in those countries that are a little bit more liberal. But again, you want to be careful. Just a small tidbit. Belgium, which is extremely open, even if you have a person from the EU who is covered by workers' comp, if they work in Belgium for an extended period of time, you're still required to get your employer's liability through a Belgian, admitted Belgian company in that country. And that very briefly sort of wraps it up. There is one other thing I do want to touch on, and that is A lot of people have been talking about the Freedoms of Services Act, which some companies and some brokers are arguing gives you complete freedom to operate in the EU as long as you have a policy there with an admitted company in another country. Two things about that. One is that's, if you read the law, it's on a temporary basis is how the wording works. And the other one is there are a number of conflicts going on, and I'll just cite one. Is the 2009 Lincolnshire oil refinery debate, in which case, not to bore you with too much detail, but very simply, there is an EU article called 56 TFEU, which applies to safety, which allows for freedom of services. However, in this particular case, that came into conflict with Article 45 of the European Union, which was concerning collective bargaining and labor agreements. And it ended up that although people thought they were covered under their insurance in another country, ended up they were not, and they needed to put into place, on a very broad basis, fully admitted policies for most of what they were doing in that country. And after that, I'll turn it back over to Jeff.
Thanks, Bruce. Dr. Nair?
Thank you, Jeff. So let's move on to the next slide, which is slide number 13. Essentially, we're now at a stage where we've found the person, we've set the entity up. Now we need to move from there. So essentially, one of the things that many U.S. companies have done in the past, which is not a good idea, is to send out a U.S. offer telling the local employee that he or she is employed at will. What you need to do is you need to establish quite clearly right up front what rights that you can have as an employer in that country that you then need to reserve. So, for example, you need to consider whether you want to put the employee on probation or not, because in most countries during the probation period, it's relatively easy to terminate. It's the closest you'd ever get to employment at will. You need to establish whether you want the right to pay the employee in lieu of notice, and you want to establish whether you want to keep the right to have an employee work basically stay on garden leave at home as a way of locking him out of the market for a period of time in order to prevent him from taking your confidential material while it's up to date and misusing it with a competitor. So a number of considerations of that type you need to go through. You need to establish whether you're going to offer them stock options. If you're going to offer them stock options, you need to determine, if you're in a country where you can do it, whether you want to make it a condition that the employee pays the employer's Social Security on any gains made at exercise, which you can do in the UK as an example, but where you have to reserve that right up front. So once you've decided all the rights you want to reserve up front, then you should produce a local country compliant employment document. When you're preparing that document, you also need to look at the country involved. It may be a country like Singapore or Hong Kong where employment law is not that onerous. It may be that you're only planning to hire 1 or 2 employees. Or it may be that the employee you're planning to hire is actually a personal friend of the CEO and is very unlikely to sue you in an employment court. Depending on all of this, you need to take a view as to whether or not you want an employee handbook, what is called a staff manual outside the U.S., but here in the U.S. we call it employee handbook. The advantage of an employee handbook is that it contains a non-contractual section on policies and procedures that includes disciplinary procedures and grievance procedures. And by signing on to them right at the start, you removed an element of argument in an employment court. In other words, there will no longer be any argument that whether or not the employee agreed to your disciplinary procedures if he wasn't performing. The argument would only be as to whether or not you operated them fairly. So you removed one element of argument out of the court case and saved your costs and hopefully your hassle. Also, when you want to terminate staff, you need to be thinking, maybe lawyers think pessimistically, but you do need to think pessimistically here, particularly if you're setting up cost-plus entities. For example, in a recent case with a client who had an employee in Netherlands that they wished to terminate, the easiest way to do it in Netherlands is to terminate for economic reasons. However, the local subsidiary was in a cost plus. In other words, it was guaranteed a profit by the parent company. So in those circumstances, in Netherlands, where you have to apply for the permission of an employment court before you can terminate, the only way you could sustain an argument that the termination is on economic grounds would have been for the U.S. company to turn up at the court and say it was in financial trouble, which it would not want to do. So often, the cost plus agreement is a tax issue. Terminating an employee is an HR issue, but the two have an impact on each other and need to be carefully considered before one works out how best to set oneself up and cover oneself in the event that one is in this unfortunate situation sometime in the future. The next slide now covers what I've just said. The offer letters and employment contracts need to be right first time. The need for a staff manual. I would say normally if you're going to hire more than about a couple of employees and you're in continental Europe or in the UK, a staff manual or an employee handbook is highly desirable. You need to sort out essentially your stock option issues, because essentially you need to check that your payroll provider does understand stock options and knows how to handle them, because if they're mishandled, liabilities can be very, very substantial over a period of time. You also should avoid, if possible, offering the stock options in the same letter as the offer letter. The offer letter should be on the letterhead of the local entity or registration, and is it simply an offer of employment. This offer of the stock options, because they're options in the U.S. company, can be made on the letterhead of the U.S. company and can be drafted in a manner that they are contractual in nature, which would lead to taking a black and white case against you in an employment court into a gray area, because you would argue in the employment court that the employment court can only look at employment issues, and the offer of the stock options was a contractual offer by another entity, the U.S. company, and not by the local subsidiary. There will be counter-arguments to it, but you've taken a black and white issue and turned it into a gray issue. And the whole point of considering these things at setup is to set yourself up with maximum protection. The last point that's important to address, particularly in the European Union, is data protection. All of the EU countries have data privacy laws that vary from country to country, but all stem from a common EU directive. And basically, it is not legal to process sensitive personal data, such as payroll information, without registering with an appropriate regulator. Even if in many countries, your headcount, in some countries, there is no threshold. Even with one employee, you have to do it. For example, in UK and France. In certain other countries, you don't have to do it for up to 2 or 3 employees. But it's much better to do it anyway right at the beginning, so that you don't have to keep track of it and forget to do it and then find you're non-compliant. The next slide covers the issue of you've got the employee on board, you've got the right documentation, he's now joined you, he's doing his job, he needs to be supported. You need a one-stop shopping for payroll. I apologize, there's a typographical error there. It says one-step shopping, it's one-stop shopping for payroll. The low headcount means that many payroll providers are not interested. You could, of course, use an accountant, but the accountant's costs are going to be higher. As already mentioned, the payroll provider must understand stock options and ESPP, and you need to keep accounts in a consistent manner. In this context, and this is where the other scenario where you are in a multi-country situation already with small headcount in multiple countries, the ability to keep accounts on your ERP system as opposed to the local accountants is highly advantageous from a variety of reasons, not least of which is that it gives you instant transactional visibility. But much more importantly, it also enables you to ensure that your accounts are kept consistently. This can be beneficial in many situations. For example, there have been instances where the tax authorities of the different EU countries tend to talk to each other a lot more today than they used to before. And in a tax audit, they often check not just the cost plus numbers for other countries, but also the manner in which you keep accounts for their entity compared to those of other entities to make sure that you're not cheating them of any tax revenue that they're owed. So keeping accounts on the client's own system is very advantageous because it ensures the consistency, and it also gives the client, i.e. yourself, a lot of additional benefits, not least of which is instant transactional visibility and the ability to run your own reports. So now you've got the payroll set up, you've got the accounting set up. What next? The next item is intercompany agreements, because without an intercompany agreement, you don't know what the revenue of your local entity is going to be, the net revenue, sales less cost of sales. Many of the sales lead generation and R&D type entities are on a cost plus type basis or a commissionaire basis, which is only a variant of a cost plus. Some of the issues that you have to consider when drafting an intercompany agreement are listed in slide 16, which is being shown right now. I'm not going to go through them all, but I am going to highlight the last two bullets, which is where a lot of exposures arise. It is very, very important for the intercompany agreement to be drafted such that the intercompany invoice does not attract indirect taxes, VAT in Europe, GST in Australia and Singapore, consumption tax in Japan, whatever it is, that the intercompany invoice does not attract indirect taxes. And that falls out of issues such as the definition of the services and the legal wording. Essentially, if you don't take care of that, there is a risk that you could have a tax audit 5 years down the line and then indirect taxes slapped on your 5 years worth of intercompany invoices, which could lead to a huge cost to the U.S. company, which the U.S. company, not being registered for the same indirect taxes, cannot now recover. So, for example, in the UK, 17.5% is a good example. 17.5% of 5 years worth of operating costs multiplied by 1.10 for a 10% cost uplift is not going to be a joke at all if you have grown your operation from a couple of people to 15, 20 people. It's also very important in the current environment where governments are short of money, and so tax authorities are more aggressive, to benchmark your intercompany agreement. So in other words, if you choose a particular cost plus percentage or a transfer price, to have available a survey of independent data that validates your choice and shows that typical independent third parties providing the same type of services as your local subsidiary have profit margins that are about the same and within the range of the profit margins that you're declaring in the local country. This is particularly important in India, where there is a big push on squeezing more tax revenue out of the Indian subsidiaries, software companies particularly, of US parent companies. And so many clients actually do this benchmarking in India every year. In other countries, such as Japan or China, the benchmarking need be done maybe once every 5 years. The next slide shows now the last but few elements, the last but one element of this piece, which is, okay, now set up, you've got your income sorted out, you've got your employees in place, your payroll's running, your accounts are going well. What are your compliance schedules? What are your compliance requirements? It is important that this may sound like a trite comment, but it's obvious that you would get this, all your compliance requirements identified up front. And of course you would. But the only reason I put this up is to flag up that in certain countries there are additional compliance filings that are required that are not straightforward. For example, in Japan, there are, if you have a KK in Japan, there are additional compliance requirements that have to be, filings that have to be made to the local prefecture, the deadlines for which are driven by the date of incorporation of the KK and not by your year end or by calendar year. So you should be very careful that you've identified all of your compliance requirements in any particular country, because often I've found clients have not done that. Also, with stock options, in certain countries there are filing requirements, in other countries there are not. But essentially in virtually every country, the laws are different to the US. So the local stock option, the U.S. stock option rules need to be made local country compliant. That's a one-off job that should be done. Many companies do it just before they get acquired or before they IPO as part of their due diligence. But really this should be done early on because it's not something that you want to get caught on. I now move on to the special issues that I touched on at the beginning. And all I can do here, special issues are special issues. They're specific to a particular client and they're often unexpected when they happen. So all I can do is give you some recent examples. For example, when you're shipping large volumes of goods into either Europe or Asia, in the case of Europe, there are cash flow advantages from a VAT point of view of shipping these goods through Netherlands or Belgium, and similar of shipping them through Hong Kong, because Hong Kong has preferential trade arrangements with countries, with China and also with Japan. So also when you're shipping the goods, depending on the volumes, for relatively low volumes, you can use a fiscal representative or you can use a bonded warehouse. These are all issues that come up often for companies that are product companies. And they usually arise when their customers turn around and say, we are not going to accept free onboard FOB shipments. We want you to import the goods and deliver to our premises and invoice us net 30 days. The second type of issue we touched on earlier is expat movements. Quite apart from the benefits and insurances, the expat movements need to be very carefully handled to cover issues such as cost of living advice, to figure out early on whether or not the company is going to offer tax equalization, and if so, to work it all out, to also cover visas and work permits, and in addition to avail of any tax breaks, such as, for example, the 30% expat tax ruling in the Netherlands. When terminations happen, they are relatively easy in the Far East. They are not easy in Europe. People say France is the worst country. It's not. Belgium is more onerous, and Netherlands is also very onerous. But it can get even more onerous if you have an employee who belongs to a trade union. We've already touched on the importance of consistent accounting in the earlier slide, but it particularly comes into its own in terms of value in tax and VAT investigations. In certain countries, such as India, we've covered the transfer price benchmarking, but there are certain tax breaks that can be availed of. In India, the tax break commonly availed of by software companies is called STPI, but it does entail, it does have benefits, particularly if you are importing a lot of capital equipment such as servers and whatnot. It does save you and enable you to have a cash flow advantage from the viewpoint of customs duties. But equally, there are additional accounting requirements, because if you have an operation that's part STPI compliant and part not, you have to keep separate accounts for the two parts of the entity. I'm not going to talk too much about Brazil, but the compliance requirements in Brazil are totally different to anywhere else in the world and are approximately, in terms of the amount of accounting effort, 2.5 to 3 times that of a typical country outside of Brazil. But it's a huge growth area, and there are a lot of our clients with operations in Brazil. In China, there are local accounting requirements, and there's a local package called King D on which accounts can conveniently be kept. They don't have year-end filings. They have quarterly filings that have to be made, and annual and monthly filings, depending on whether you have a WOFE structure, a wholly owned foreign entity structure, a subsidiary structure, or a rep office structure. I'm now coming to my last but one slide, where I'm going to go back and now look at the multi-country low headcount operations. It is possible for companies in this type of scenario to achieve very, very significant economies of scale, not just avoid dealing with a headache with the 80-20 syndrome, but actually turn the 80-20 round into a 20-80. Essentially, it is possible to, by maintaining accounts on the US ERP system, if it's a decent ERP system like NetSuite or Intact or Oracle or SAP, to actually keep all of the accounts of all of the entities within that system, to ensure that the transaction inputs are carried out consistently, that SAS 70 processes and financial control processes are implemented, devised and implemented consistently, that time spent in making payments and both to vendors and payroll is minimized by integrating it with the accounting software, and even more surprisingly, one can map accounts within the system so that essentially you can map from a US chart to a local country chart of accounts within some of these systems, such that when you reach your year end, your local country statutory accounts, probably 75% of the work is already done by the system rather than having to be done manually by an accountant. And then all you have to do is make some adjustments for issues like stock options, and essentially produce the reporting package, thereby reducing the amount of work and therefore cost to the client. So there is an ability for companies in multi-country situations to be able to outsource these scenarios to providers operating from low-cost locations in places like India that can result in a very high accuracy, low-cost result to the client's benefit. I want to end this presentation by showing you the last slide, which lists the countries where we currently have clients, and to thank you very much indeed for listening to this presentation, and I hope you got something out of it. Jeff, over to you.
Thank you, Dr. Nair. Let's move quickly into the question and answer segment of the webcast. We've got several questions here from our audience. Let me begin with this one, and Christine, I'm going to send this to you. We're sending one of our U.S. employees to Hong Kong to set up an office. He'll be in Hong Kong for at least a year. Can we keep him on our U.S. benefit plan, or do we need to find him other coverage?
Well, if the employee is going to be living overseas for 6 months or more, he would be considered an expat and would be eligible for a plan that includes medical, dental, life, and evacuation coverage. However, I do want to caution you on one thing. When we're dealing with individuals, medical underwriting would be involved, so we would want to get that employee set up about a month in advance.
Great, thanks. Let's see, Bruce, maybe you can take this one. Are we seeing security claims in countries outside of the U.S.?
It's very interesting. I mean, historically, the U.S., and it still is, the mother lode for securities claims. But yes, we're seeing dramatic increase in security claims activity. In fact, here's a shocker. I just read a study not too long ago. There were 2,000 security claims in China in 2009. So, I mean, here's an example of the kind of significant growth in that area that has taken place.
Thank you. There's a question here in India. Shan, maybe you could take this for me. Can you comment on the implications of the Shops and Establishments Act in India?
Yes. Essentially the Shops and Establishment Act is a state-driven legislation that it has got different names in different states, but in many of the states it's called the Shops and Establishment Act. It's basically there to ensure that if you are setting up a business in a particular state in India, that you register with the authorities. However, the Act also contains local regulations, such as the number of additional paid public holidays that are declared in the state, in that particular state. And these holidays vary from state to state. So it's very important when you draft your India employment document that you take account not just of the central government employment laws, but you also take account of the additional HR regulations of this type which are embedded in the Shops and Establishment regulations. And often people say Shops and Establishment regulations, I don't have to look at that because that's just a requirement for me to register and get that registration number. But if you look at the regulations, there are HR issues in there that you have to address.
Great, thank you. Shan, this question would probably be best posed to you as well. Is there an advantage to hiring an independent contractor versus a sales rep for a salesperson in the UK? Any special issues in the UK either way?
Very much so. If you're going down the contractor route, you need to ensure that the contractor has got at least 4 other customers. So he's got at least 5 customers, including you, that he provides his tools of trade, that he is given a job to do but is free to do it as he wants, when he wants, so long as he provides you with the deliverable on the due date, and in effect that he is in control of his own destiny. Often U.S. companies hiring contractors, when you start looking at it more carefully, the contractor is effectively an employee because the contractor has only got one customer, the U.S. company, effectively reports to the VP of sales, to a U.S. VP, and is given all the tools of his trade. For example, he may be working from home, but he's given all the leads to follow through. He's given a laptop that the U.S. company has purchased, and he's expensing his travel claims. And at that point, you're actually worse off having the person as a contractor than an employee, because the risk is that, let's say the contractor agreement has a 30-day notice period. You give him 30 days notice, and the next thing you know is that he's gone to an employment court and slapped you with a lawsuit claiming that he has a deemed employment relationship with you. And in fact, his relationship with you is a deemed employment relationship. So essentially that's the first risk. The second risk is that as soon as that happens, or even otherwise, the tax authorities can pick up on this and come back and tell you, well, the sums you paid the contractor, because he was your employee, we say they're net payments. So we're going to gross it up and you pay us the taxes on it. And last but not least, if the U.S. company has a contractor engaged in this way in a deemed employment relationship for, say, 2-3 years, the U.S. company has now been operating for 2 to 3 years in the U.K. with effectively an employee. If that employee has been successful and generated profits for the U.S. company, the U.S. can now become taxable in the U.K. on those profits. So if you're going to employ a contractor, please make sure that you engage a limited company. In other words, don't engage an individual. Ensure that the individual has his or her own limited company that you contract with. If that is not on, you're actually much safer employing the person and putting him on a probation period. Because in the UK you can have up to a probation period, you can have an extensive probation period, easily up to 9 months. And during that probation period, if things don't work out, you can terminate, not quite without giving a reason. You have to go through a process, but it's a much easier process to actually terminate during the probation period. I just spent a little bit of time on this because we come across this scenario often, and it's often a case where there is an exposure. I mean, having said that, you may well take a view that I'll take a calculated risk on this, and that's your call. But if you take a calculated risk on this, please be aware that you are taking one.
Thanks, Shan. Well, we've reached the end of our time for today. I want to thank Dr. Nair and Christine and Bruce for their participation in the webcast, and thank all of you in attendance. I hope you found the webcast helpful. Again, we'll be sending each of you an email that will include a password to access the presentation on our website. Thank you again, and take care.
Thank you.